Hello, everyone. This is Lutfur Rahman, the course coordinator of GSBS 6130 Corporate Finance. I hope all of you are doing well, a little bit relaxed after completing your first assessment, mid-trimester test. When you are watching this video, you should have already your marks for the mid-trimester test. So the main purpose of this video is to explain the answers to your mid-trimester test questions. So you can match the suggested answers with your answers to identify whether there was any deviation or what was the right approach to solve these problems. So let me share my document, which is the mid-trimester test paper. So in the first part, you had 10 MCQ questions, and each question had 1 mark. I'm not going to explain each of these MCQ questions. So if any of you have any query about any of the MCQ answers, you can contact me. I will explain you. For this MCQ part, for each questions, I created a pool of 3 questions. For example, you can see for question number 1, there are 3 questions of very similar content, and each of you got 1 of these 3 questions randomly. Okay, and same as question number 2, question number 3, and so on. So that's about the MCQ. And once again, you can check whether your MCQ answers were right or not. And if there was any mistake you have made, any wanted clarification, you can let me know later. So I'm straight away going to the written part, the part B, where you had 3 written answer questions. Question 11 and question 13 were a mathematical problem, whereas question 12 was a theoretical question. So this is question 11. And for these written answer questions, you had a pool of 2 questions for each, which means that each of you randomly got 1 of the 2 questions. These questions are pretty much the same in the pool, just some numbers were different. So let's start with question 11. Luke borrows 800,000 from a bank to set up a medical practice. He agrees to pay a fixed interest rate of 10.2% per annum, calculated monthly, and to repay by equal monthly installments over 10 years. So the first part of this question was calculate monthly repayment. Then by how much does Luke's first repayment reduce the principal? And if the loan is paid off as planned, by how much will the last repayment reduce the principal? As I told you in different occasions, that each mathematical problem in this course is based on some theoretical understanding, based on some theories. That's why you first of all need to appreciate the theory behind it, then you solve the problem. So you understand the issue first of all, and then you solve the problem, then you approach the problem. It's not necessarily that you just picked up a formula, put all the numbers, and you get the result. You need to understand it first. I have finished marking your mid-trimester test papers, and most of you did the first part correctly, the monthly repayment, but many of you had some difficulties in part B and part C. So first of all, you were given a 10.2% per annum interest rate calculated monthly. So first of all, we need to calculate monthly interest rate. Straight away, we divide this number by 12. So this is our monthly interest rate. And installment will be monthly. So in 10 years, there will be 120 months, 12 months a year. So 10 years means 120 months. Principal is 800,000. Then you need to set up this equation, because you know that the present value of all the installments should be equal to how much you are borrowing today. So 800,000 in the left-hand side, and these a present value annuity factor equation in the right-hand side. So we are given with all this information, except we don't know what is the value of C. That means what is the value of our each installment. So 1 divided by the monthly interest rate that we calculated earlier, and all of you know this is present value interest factor of an annuity formula. 120 is a number of periods. So if you solve for C, we find that it is 10,661. So that is the monthly installment. So as I mentioned, that most of you did up to this correct. The next part of the question is how much does Luke's first repayment reduce the principal? So essentially, for the first installment, you need to find out how much is the interest and how much is the principal, right? It is a very straightforward question if you would have understood it correctly, because in the first month, you should calculate the interest on the entire amount because no principal has been repaid yet, okay? So you can see that your installment is 800,000 and your first month interest or monthly interest rate is 0.0085. So which means that your first month's interest payment is 6,800. So your installment is 10,660 and interest payment is 6,800, which means that this is the amount of principal that you repay with the first installment. You all right? Okay. Then the last part of the question is, if the loan is paid off as planned, how much will the last repayment reduce the principal? Okay. Now look, last repayment is 10,000 because our monthly installment is 10,660, right? And last repayment is also 10,660.86. So as a result, the principal at the beginning of the month should be the present value of this installment, present value of this installment at the beginning of the month, right? So you simply divide 10,660.86 by 1 plus interest rate. So this is the amount of principal you pay with the last repayment. Okay, so this is question number 11, and this is how you should solve this problem. The other question in this pool is exactly the same, just some number different. For example, instead of 800,000, there was 900,000 and so on. So the way you solve this problem would be exactly the same. So you can see that instead of 800,000, it is 900,000, and instead of 10.2%, it's 12%, but the approach is exactly the same. So if you want to have a look at the answers, so monthly installment will be 12,912, and principal payment with the first installment will be 3,912, and principal payment with the last installment will be 12,784. Okay, so next, let's move to the next question. This is 5 marks, not 4. Okay. Look, once again, you had 2 questions in the pool, and each of you randomly got 1 of them. So first question in the pool is, look, risky assets can be combined to form a riskless asset. Do you agree? Discuss. So what answer I was expecting here? First of all, you should clearly mention that yes, I agree or I don't agree. Okay, and then you explain. Many of you touch base the answer. Okay, however, I hardly find the main point, because if you have, for example, 2 risky assets and you put them in a portfolio, whether this portfolio can be a riskless portfolio, that is the question, right? Now, theoretically, it's possible, yes, because if you have 2 assets, and if these 2 assets are perfectly negatively correlated, this point is the most important part in this answer. Perfectly negatively correlated. I observed that some of you mentioned that if they are perfectly correlated, or if there is lack of perfect correlation. Look, you need to mention perfect negative correlation. If you only say perfect correlation, that doesn't mean anything, because whether it's positive correlation or negative correlation, that actually determines that whether it's possible to form a riskless portfolio or not. Okay, so it has to be perfect negative correlation, not only perfect correlation. Anyway, so if the correlation is -1, for example, so perfect positive, perfect negative correlation, then if you put these two assets in a portfolio, the variance of this portfolio will be 0. So theoretically, it will be a riskless portfolio. However, you can argue that in reality, it's maybe very unlikely that you find two assets with perfect negative correlation. So to summarize, theoretically, it's possible. However, in reality, it's maybe difficult to get two assets with such perfect negative correlation. The next question, it is part B of the same question. Whenever an asset is added to a portfolio, the total risk of the portfolio will be reduced, provided the returns of the asset and the portfolio are less than returns of the asset and that of the portfolio are less than perfectly correlated. Now, many of you have tried to explain that this statement is correct. It is not necessarily correct, okay? I mean, it's not always correct, because look, when we talk about the diversification benefit, we do not explain diversification benefit in a way that we add an asset in a portfolio. Let me show you this. Let's say that you have a portfolio, right? You have a portfolio and it has two assets already, A and B, and you have a third asset, C. Okay. The question is telling you that if this C goes into this portfolio, the riskiness of this portfolio will decrease. But this is not how we explain the diversification benefit, because look, in this current portfolio where you have A and B, these two stocks may be very low risky and stock C may be very high risky. And as you put that in the portfolio, the overall riskiness of the portfolio may increase rather than decrease. Okay, so this is not how we explain our diversification benefit, that we add more stocks in the portfolio so the portfolio risk will decline. Rather, the way we explain diversification is whenever we create a portfolio, the riskiness of the portfolio is overall riskiness of the portfolio is less than the weighted average risk of the individual assets. Okay, so for example, you have two assets, A, B, and C, right? If you put C in this portfolio, then you will have an overall riskiness of the portfolio, the variance of the portfolio. Now, this variance of the portfolio will be less than the weighted average variance of individual asset if they are less than perfectly positively correlated. So if two assets are perfectly positively correlated, then putting them in a portfolio will not provide you any benefit, because the overall riskiness of the portfolio and the weighted average riskiness or weighted average variance will be the same. However, if two assets are less than perfectly positively correlated, then putting them in a portfolio will make the overall riskiness of the portfolio less than the weighted average. Okay, so this is how we explain the diversification benefits. This is the next question in the pool. Total risk can be decomposed into systematic risk and unsystematic risk. Explain how each component of risk is affected by increasing the number of securities in a portfolio. So in this question, I was expecting a very clear, a very precise answer that if you add more and more stocks in the portfolio, what happens to systematic risk and unsystematic risk? So many of you provided your answer, tried to explain, however, that explanation lacks a clear statement that yes, increasing the number of securities increases this risk or decreases this risk. Anyway, so as we learned in week 5, that unsystematic risk is the risk specific to a particular investment or particular asset. That's why as we put more and more assets in a portfolio, I mean, increase the number of securities in a portfolio, unsystematic risk will reduce. And eventually, unsystematic risk will be diversified away, okay? Because you are putting more and more stocks in the portfolio. On the other hand, systematic risk is the risk that arises from market-wide factor. For example, inflation rate, interest rate changes, natural disaster, and so on. That's why putting more and more stocks in the portfolio will not mitigate or will not diversify the systematic risk. Okay, so the summary is increasing the number of securities will reduce unsystematic risk or diversify away unsystematic risk, but systematic risk cannot be diversified away or cannot be reduced by increasing the number of securities in a portfolio. The other part of this question was an important conclusion of the CAPM, capital asset pricing model, is that the relevant measure of an asset's risk is its systematic risk. Outline the significance of this conclusion for a manager making financial decisions. Look, capital asset pricing model, we learned about it, and capital asset pricing model shows that the required rate of return of an asset is a function of its systematic risk. Why? Because it is assumed that investors will typically hold a diversified portfolio. That's why unsystematic risk will be diversified away. So only the risk that matters is the systematic risk. Okay, so that's why a manager that makes financial decision, for example, dividend decision, capital structure decisions, or project investment decision, a manager that makes this type of decisions should consider that to maximize the market value of company's equity, what matters is addressing company systematic risk. Okay, managers also should ensure that investor gets sufficient compensation for the systematic risk they take by investing in company equities. Okay, so this is the answer to the second question in the pool. And once again, each of you randomly got one of these two questions. This is the last question. Once again, two questions, they were just different in terms of some numbers. They were exactly the same in other ways. So look at this question. A company is considering the installation of a new machine at a cost of $60,000 to replace a machine purchased 7 years ago for $100,000. The disposal value of the old machine is $15,000. Both machines will have similar outputs and will produce work of identical quality. The estimated yearly costs of operating old machine are, so old machine's operating cost of $22,000 and that of new machine is $11,000. Both machines have an estimated remaining life of 3 years, at which time both machines will have a zero estimated disposal value. Assume that your required rate of return 10% and operating cost of the old and new machine incurred at the end of each year. So you need to calculate NPV of the old machine, NPV of the new machine, and you need to take a decision that whether the company should continue with the old machine or replace the old machine with a new one. We had similar type of problems in our workshop and practice question set. So all we need to do is we need to consider these two projects separately. Okay, so we need to find out the present value of these two separately, and we should find out that whether we should go with. Okay. Once again, I have checked your answers. Many of you approached this question fairly correctly, but maybe misunderstood a couple of points. Let me tell you. First of all, for example, this is the project. You continue with the old machine, and this is the project you continue with. You go for a new machine. Now, as far as the old machine is concerned, Some of you have considered the purchase price of the old machine, 100,000, but you should not consider it because it was purchased 7 years ago. So that's a sunk cost that doesn't have any relation with your project decision now. So only what relevant is the operating cost of the old machine, which is $22,000, and you use the present value annuity factor because this cash flow comes every year for 3 years. And this is the present value of the operating cost or operating expenses. Okay. If you go for the new machine, then look, if you go to buy the new machine, you will sell the old machine, right? So that's why initial cost of the new machine is now you should consider $60,000. That is the purchase price of new machine. And you also consider the disposal value of old machine. Many of you made a mistake here that disposal value of the old machine was considered as a cash flow when you considered old machine. However, that is a mistake because look, this 15,000 is the disposal value of the old machine now. So if you are assuming that you may continue with the old machine for another 3 years, you don't get this disposal value because you do not sell your old machine. You continue with your old machine. So this 15,000 comes when you are considering purchasing new machine, not when you decide to continue with the old machine. So $60,000 is your investment. $15,000 is the cash inflow that you receive from the sale of the old machine. And then you find out the present value of the operating cash flows. Okay. So these two is your initial cash flows. And this is the present value of your operating cash flow. And if you find, you will see that it is negative $72,000. So you can see that these are the present values of operating cash flows, basically, right? Or the present value of the cost, operating cost. That's why you should look at which one is lower. Although normally we would see which one has a higher NPV, but in this case, we do not have an operating cash inflow. That's why we look at the present value of outflows, and you can see that old machine has a lower present value of operating costs. That's why we will continue with the old machine. Okay, so that is one point that many of you made a mistake when you calculated, when you incorporated the disposal value of the old machine in the new machine project. And just a couple of additional points here. Many of you unnecessarily complicated this problem. For example, some of you assumed a depreciation, like a straight line depreciation, then you calculated depreciation. Look, no information is given here about depreciation. So when you are not given any instruction about anything, you rather make a simplified assumption rather than making it complicated. Okay. So if you really want to make an assumption about depreciation, you should simply assume that there is ignore depreciation. So you simplify your calculation. Okay. So if you assume a depreciation, charge depreciation, find out book value, you are unnecessarily complicating because in the problem, there is no mention of depreciation. This is the first thing. The second thing is many of you have brought operating cash inflows. Okay, about no operating cash inflows are given here. Look, if you assume an operating cash inflows and same operating cash inflow for both the project, that is not going to change your decision. Like if you assume that 100,000 will be the operating cash inflow yearly for both the old machine and the new machine, that's not going to change your decision. Unnecessarily, that will complicate your estimation. So you don't need to make that assumption. And finally, some of you also consider taxes. Okay, if you ignore depreciation, you simply ignore taxes. You don't need to assume any tax. Okay, and without making an assumption about depreciation, without assuming a tax rate, without assuming an operating cash flow, you still can fairly solve this problem and make a decision that which problem or which project you should be going with. Okay, so once again, the summary is if no information is given about any point, and if you want to make it assumption, make a simplified assumption, like ignore rather than making it complicated. This is one point. And another point is there is no point of making the same assumption for both the project. For example, if you say that both the project has equal operating cash inflows, both the project has equal depreciation, both the project has equal investment. If you make these sorts of assumption, that's not going to change your decision. So there is no point of making such assumption and complicating your estimation. Okay, so that was the last problem, and the other question in this pool was the same, just some different numbers. So if you want to see these results, present value of the operating cash flow of the old machine is 72,000, and the present value of the operating cash flow of the new machine is 66,000. So you should go for purchasing the new machine rather than continuing with the old machine. Okay, so I think I have explained enough the answers to your mid-trimester test questions. But if you have any confusion in your mind, or if you want any further clarification, don't hesitate to send me a quick email. Okay, or you can ask me during our consultation or in our live sessions. Okay, so thank you very much. Very, very best of luck.